Go. Hello, everyone. My name is Kabir,
Hello, I'm Lily.
Hi, I'm Natasha.
and in today's workshop, we will be talking about IAS 38, intangible assets. We'll first start with the objective and the scope. It it starts with the purpose of IAS 8, which is to provide guidance on how to disclose, recognize, and measure intangible assets. Intangible assets abide by IAS 38, except for the following cases. Intangible assets that are within the scope of another standard. In this case, intangible assets may not abide by IAS 38, and guidance on these assets may fall under a specific standard that isn't within the criteria of IAS 38. Next is financial assets as defined in IAS 32, financial instruments presentation. Financial assets are assets that provide cash, equity instruments, or contractual rights. These types of assets would follow the specific criteria outlined in IAS 32. The recognition and measurement of exploration and evaluation assets, which you see IFRS 6, exploration for and evaluation of mineral resources. So when talking about the measurement of exploration and evaluation assets, these are mineral and oil exploration and don't fall under IAS 38. Next is expenditure on the development and extraction of mineral, oil, natural gas, and similar non-regenerative resources. So as discussed in the above point, an asset that is for exploration and evaluation assets are recognized and valued depending on the criteria in IFRS 6. To continue with the scope is some examples of intangible assets that don't follow IAS 38 include inventory held for sale, which you follow IAS 2 inventories. So for example, a retail company will purchase stock of smartphones for resale. The products will be classified as inventory, however, they won't be accounted as intangible assets under IAS 38, as they are goods that will be sold in the normal course of business. Next is deferred tax assets, which falls under IAS 12, income taxes. For example, a company will be subject to loss in the year and will carry the amount forward to offset future taxable income. It represents a future tax benefit. The next example is leases of intangible assets, which follows IFRS 16 leases. The company leases a patent from a different company, and the lease will be accounted under IFRS 16 as a lease arrangement. Next example is financial assets, presentation and recognition of financial assets, which falls under IAS 32, IFRS 10, IAS 27, and IAS 28. For example, a company invests in stocks of another company, counted as a financial asset. This example would abide by all the standards as it meets the recognition, presentation, and measurement of the assets under these criteria. Next one is business combination goodwill, which follows IFRS 3 business combination. The company will acquire another business for 20 million. Fair value of identified net asset is 8 million. The difference between the two values is 2 million and recorded as goodwill. We'll discuss more about business combinations of goodwill later in the workshop. Many intangible assets come in many forms, and some are stored internally or externally on a tangible object. For the tangible and intangible portions of these assets, the accounting treatment may be difficult as two standards may apply. One will be IAS 16, property, plant, and equipment, and the other will be IAS 38, intangible assets. Companies must apply a professional knowledge to distinguish which standard is the appropriate approach. To determine which standard to apply, we need to look at the following criteria. If a key component of an asset is integral for the asset to operate, which means basically that the asset is made of parts and is valuable, that without them, the asset wouldn't work. If a single part is essential to the makeup of the asset, it is treated as a single unit. The other criteria is asset is separable from the key component and both operate on a standalone basis. Some assets can be separated into individual pieces and will be able to work effectively. If this is the case, then the asset can work as a separate unit. Example of assets that follow IAS 38.4 are advertising, training, and research and development. To dive deeper into research and development, it would be the process or activities of gaining knowledge. And this would mean that even if the asset is a physical substance, the key part would be the intangible knowledge, while the physical substance would be the secondary. Additional elements that would follow this standard include films, videos, and recordings, and are excluded from IFRS 16. We can see that within IAS 38 that some assets may not follow the standard, and thus situations where transactions are specialized follow different standards, such as development and extraction of oil, gas, and mineral deposits, and insurance contracts. Next, we'll talk about some definitions. We'll first start with amortization, which is where the cost of an asset will be allocated over the life of the asset. Next is the carrying amount. It is the current value of an asset that will be illustrated on a company's financial statements. It is calculated by subtracting any damages and accumulated depreciation from the original cost. The next definition is development. It is the process where a company will take ideas, research, and knowledge to develop new or improved products or services. The next one is entity-specific value. It is the cash flows a company expects to have on their financial statements from using its assets until it is disposed at the end of its useful life or the cost to settle any obligations. Research is where a company will attempt to learn new things by spending time studying and exploring. Okay, now we'll dive a little bit deeper into intangible assets. It is a valuable asset, more specifically a non-monetary asset that company owns and controls but has no physical element. Companies will spend money or take on debt obligations to be able to obtain, develop, or improve on their assets that don't have a physical form. Some examples include computer software, patents, picture films, franchise, and copyrights. The criteria to abide to IAS 38 in IAS 38.10 is many of the items are recognized as intangible assets based on these three criteria: identifiability, control over a resource, existence of future economic benefits. If the items do not meet these three criteria, the cost to purchase or produce the intangible asset will be accounted as an expense. Only if the items are purchased due to consolidation will they be accounted for goodwill at the date of purchase. Now to look at specifically identifiability. An intangible asset is subject to the idea that it needs to be identifiable. Otherwise, it will be considered goodwill, meaning the company must be able to be separated from the company to be considered an intangible asset. Goodwill from a business combination will allow for benefits that come from other assets and thus wouldn't be considered identifiable or separate. Assets considered identifiable, for example, are if it can be obtained due to contractual or legal rights, separable from the company, and allow them to be sold or exchanged by itself or together. Identifiability means that for companies that have intangible assets, the asset must be able to be separated from the company so that it will be capable of being exchanged or sold. For an intangible asset to come to life, it has to come from legal right or contract, even if the asset's right can't be exchanged to another entity. Next, we'll look at control. The company has control over an asset if it can generate monetary benefits in the future, and only the company can receive the benefits. Typically, legal and contractual rights help ensure benefits received from assets flow and are controlled by an entity. Market and technical knowledge would also be deemed to have monetary benefits and are enforced by legal rights. Some examples per IAS 38.14 is copyright, restraint of trade, legal duty on employees to maintain confidentiality. This means that the asset that the company owns and controls will allow it to earn money or cash in the future, and no other entity is capable of benefiting from the asset. It's usually implemented through legal rights. Two examples within control are skilled staff. So a company may have skilled staff where the training, growth, and improvement in skills have the potential for economic benefits. However, the company lacks ownership of monetary benefits from skilled staff to be considered intangible assets. Skilled staff are typically not intangible assets unless enforceable rights or criteria of intangible assets are met. Next is the portfolio of customers. The company has strong relationship with clients or a strong market share, which allows for the monetary benefits to flow to the entity. However, there are no contractual rights that ensure the benefits can be controlled by the entity. Only in the case of exchanges and customer relationships will benefits be accounted for by the entity as deemed to be separable and abides by criteria of intangible assets. Finally, we'll be talking about the future economic benefits. An intangible assets flow of benefits to a company consists of revenues from products and services, cost savings, or other benefits from using the asset, meaning that the item is capable of helping the entity earn money or save on costs in the future. Now I'll be handing it off to Lily, who will be talking about recognition of intangible assets.
So now I will be discussing the recognition of intangible assets. An intangible asset can be either purchased or self-created, but it will only be recognized if two key criteria are met. So first, the cost can be measured reliably. This means the company must have a clear measurable value for the asset. Second, it is likely to bring future economic benefits. The asset must have the potential to generate future profit or value for the company. When determining the probability of future benefit, the companies must use realistic and supportable assumptions based on what is likely to happen during the asset's useful life. Now let's move on to what happens when the recognition criteria are met. So when the criteria are satisfied, the expenditure related to the intangible item will be recorded as the cost of an intangible asset at the time it's acquired. These expenditures include the cost to acquire, such as purchase price and import duties, directly attributable expenses. These are the costs that can be directly linked to getting the asset ready for use, like legal fees, labor costs, and testing costs. However, if the recognition criteria are not met, then the expenditure cannot be capitalized as an asset. It must be recognized as an expense as soon as it is incurred. So expenditures that cannot be included in the asset's cost include advertising and promotion costs, costs for entering new market or working with new customers, like employee training fees, administrative or general overhead costs, any cost for subsequent addition, replacement, or maintenance of the intangible assets. Now let's talk about how intangible assets are recognized when they are acquired in a business combination. If an intangible asset is acquired during a business combination and meets the recognition criteria, the company should record its fair value as the cost on the acquisition date. The fair value can be determined using one of the following methods: the asset's bid price in the active market. If there are no current bids, but the market is still active, the company can use the price from the most recent similar transaction, unless significant changes have occurred in the economic conditions. If there's no active market, the price the company would pay in a fair transaction should be used, considering recent similar deals. The company can also use a revenue or profit multiple based on market transactions, or calculate the asset's discounted future cash flows. Moving on to the recognition of internally generated assets. The recognition process for these assets is split into two phases: the research phase and the development phase. In the research phase, any cost related to research must be recognized as an expense as soon as they are incurred. So examples of research activities include the expenses on obtaining new knowledge. This involves conducting experiments to gain deeper insights into a particular field, or expenses for searching for alternatives, such as finding new materials or process that can be used to improve the existing product or service. Now let's move on to development phase. In the development phase, development costs can be recognized as an intangible asset only if they meet all of the following criteria. First one is completion intent. The company must finish and use or sell the asset. Feasibility. It must be technically possible to develop the asset for use or sell. Future benefits. The asset must be able to generate future economic value. Measurement. The development cost can be reliably tracked and measured. Resources. The company must have enough resources to complete the development and use or sell the asset. Use intent. The company must have the ability to use or sell the asset. Importantly, no expenditure incurred before meeting these criteria can be added to the asset's cost. Examples of developing activities include designing or testing prototypes or models before production. Next, once the 6 criteria are met, the following direct costs can be capitalized. Raw materials and service used to generate the asset, direct labor cost, legal fees for registration, amortization of related intangible needed to generate new assets, and interest or borrowing costs. So here I have an example I took from the textbook. the following expenditure were incurred by the company developing the laser machine during the R&D phase. As you can see, number 6 to 8 and 11 represent the direct cost, testing costs, legal fees related to bring the patented product to the market for future use and sales. These can be capitalized as an intangible asset once the 6 development criteria are met. Regarding number 12, if a patent is successfully capitalized because it helps secure future economic benefits. When a research and development project is acquired through a business combination, the associated costs should be recognized as an intangible asset, even if they include some research-related costs under IAS 38-34. This is different from what we have seen for the internally generated assets, where research costs are typically expensed. However, future costs related to the project are expensed unless they meet the recognition criteria for intangible asset. Recognition of internally generated assets such as brands, mastheads, publishing titles, customer lists. According to IAS 38, these types of internally generated assets cannot be recognized as intangible assets. This is because it's very difficult to reliably measure the cost spending on creating them. Instead of being directly tied to improving the brand or mastheads, much of the expenditures is aimed at improving the overall business of the company, since it is not possible to attribute specific costs to these intangible assets. They cannot be recognized under IAS 38. In other words, the costs related to creating these assets are often considered part of the broader business growth, not an identifiable asset in itself. Moving on to recognition of an expense. Expenses related to intangible items are generally recorded as costs when incurred, unless it's part of an intangible asset that meet the recognition criteria, or it's acquired in a business combination but cannot qualify as an intangible asset. In this case, the cost will be included in goodwill on the acquisition date. For example, imagine Company A buys Company B for 20 million. Company B has a strong customer base and good supplier relationships. These cannot be recognized as intangible asset. So instead, their value can be included in goodwill on Company A's balance sheet. So the following items must be recognized as expenses when they incurred. First one is internally generated goodwill mentioned in the previous slide, and research costs, not part of the business combination, startup costs like legal fees and pre-opening expenses, training costs, advertising and promotional costs, relocation costs. However, if the entity has made a prepayment for any of the above items, the prepayment should be recognized as an asset until the entity actually receives the goods or service related to the prepayment. So any expenses on intangible items that have already been recognized as expenses should not be reclassified as intangible assets at a later date. Now I'll be passing the part to Natasha.
All right, so now we will look at how to account for intangible assets after their initial recognition. After recognition, an entity can choose between the cost model or the revaluation model to continue measuring their intangible assets. When using the cost model, after initial recognition, intangible assets are carried at cost minus accumulated amortization and accumulated impairment losses. Whereas, when using the revaluation model, after initial recognition, intangible assets are carried at a revalued amount. We will take a closer look at the revaluation model. The revalued amount is calculated by subtracting any accumulated amortization and accumulated impairment losses from the fair value of the asset. The fair value is determined by comparing the asset to similar assets in the active markets. It is important that the revaluation amount is up to date so that there is no material difference between the asset's carrying amount and fair value at the end of each reporting period. The revaluation model does not allow the revaluation of intangible assets that have not previously been recognized as assets or the initial recognition of intangible assets at any amount that is not cost. This means that in order to use the revaluation model, the intangible asset must be initially recognized as an asset at cost. At the revaluation date, the intangible asset must be adjusted, and there are two options that an entity can choose from. The first involves adjusting the gross carrying amount to the revaluation amount, or the company can choose to remove accumulated amortization from the gross carrying amount of the asset. When an asset is revalued, the carrying amount can increase or decrease. If it increases, the increase is recognized in other comprehensive income and accumulated in equity under revaluation surplus. The increase would only be recognized in profit or loss if it reverses a previous decrease that was recognized in profit or loss. If the carrying amount is decreased, the decrease is recognized in profit or loss unless there is a credit balance in the revaluation surplus for that specific asset. Then the decrease is recognized in other comprehensive income. When accounting for intangible assets, an entity must determine if the asset has a finite or indefinite useful life. If finite, the useful life must be determined, and there are 8 factors that are considered, as noted in IFRS Made Easy. These include current and potential competitors, the period of time the entity has control over the asset, if the asset is dependent on others, the typical product life cycle of the asset, the maintenance needed to continue future economic benefits, any changes in market demand and the stability of the industry, any obsolescence that could have an effect on the asset, and the expected use of the asset. In terms of intangible assets arising from contractual or other legal rights, the useful life of these assets can be shorter, but not longer than the contractual or other legal rights. If there are terms for renewal, they would be included in the useful life as long as the renewal does not result in significant costs to the entity. There are 3 factors that, if satisfied, would indicate that the renewal of the contract or other legal rights would not result in significant cost. The first is evidence that the contract or legal right would be renewed. The second is evidence that any conditions necessary for the renewal will be satisfied. And finally, that the cost to the entity is not significant compared to the economic benefits that can be expected from the renewal. Moving forward, I will discuss intangible assets with their finite useful lives in more detail. The depreciation amount for these assets is allocated over the asset's useful life and begins when the asset is available for use. The amortization period ends when the asset is held for sale or when the asset is derecognized, whichever comes sooner. The depreciation method used should follow the same pattern as the economic benefits that will be used by the entity. However, if no pattern is found, then the straight line method is used. Amortization is recognized in profit or loss unless it is otherwise stated in another standard or it's included in the carrying amount of the asset. The residual value of an intangible asset with a finite useful life is assumed to be 0 except for the following 2 situations. The first is if a third party is planning on buying the asset at the end of its useful life, or the second is if there is an active market for the asset. The market must be able to determine a residual value for the asset, and the market must exist at the end of the intangible asset's useful life. An intangible asset has an indefinite useful life when there is no foreseeable limit to the period where the asset is expected to generate cash inflow for the entity. Indefinite intangible assets are not amortized, and instead they are tested for impairment. This is done by comparing the recoverable amount to the carrying amount annually, and whenever there is a sign the asset may be impaired. Annual review of the asset must be done to determine if the asset is still deemed to have an indefinite useful life. An intangible asset should be derecognized on disposal or when future economic benefits are no longer expected to flow from the asset. A gain or loss will be recognized from the derecognition, which is calculated as the difference between the net disposal proceeds and the carrying amount of the asset. The gain or loss is recognized in profit or loss unless IFRS 16 applies. It is important to note that amortization of an intangible asset with a finite useful life does not end when the asset is done being used, unless the asset is fully depreciated or it is classified as held for sale. Each class of intangible assets must be specified between those that are internally generated and other intangible assets. Each class must also have the following disclosures: the nature of the useful life, the amortization method used, the gross carrying amount along with the accumulated amortization, items of the statement of comprehensive income where amortization is included, and the reconciliation of the carrying amount. For assets with indefinite useful lives, the carrying amount and reasons for deeming the asset to have an indefinite useful life must also be disclosed. For assets that are material to the entity, a description, the carrying amount, and amortization remaining should be disclosed. Intangible assets acquired by a government grant and recognized at fair value should disclose the fair value that was recognized, the carrying amount, and the choice of measurement after recognition. Intangible assets that have a restricted title or those that are pledged as security for liabilities should be noted as well as any contractual commitments. If the revaluation method is chosen, the entity must disclose the date of revaluation, the carrying amount, and the carrying amount if the cost method was used for each class of intangible asset. Also, the amount of revaluation surplus should be noted. For research and development costs, the aggregate amount of research and development recognized as an expense in the period should be disclosed. And now Kabir will go through some examples.
Right, so we're really talking about two companies that fall under TSX and have proper disclosures and recognition of intangible assets on their financial statements. So the first is Shopify. As we can see, they provide a breakdown of their financial statements with intangible assets disclosed and the amortization provided on the right-hand side. We can see here that Shopify is using the net book value, which follows IAS 38.74 and 38.75, which states that after initial recognition, the intangible asset should be carried at their gross amount minus any accumulated amortization and accumulated impairment losses. Now we were talking about TELUS. As we can see, we chose this company as it follows TSX, as well as it has a proper breakdown of the financial statements for intangible assets and goodwill, which includes the balance at January 1st, 2024, and the additions and disposals all the way up to September 30th, 2024, which is the final balance. We can also see here that TELUS has noted its disclosures to the consolidated financial statements, the amount of amortization that its intangible assets are subject to. This follows IAS 38-118, which states that the amount of amortization must be disclosed, as well as within their notes, they state that accumulated amortization of goodwill is amortization recorded prior to 2002. Therefore, there are no accumulated amortization impairment losses in the accumulated amortization of goodwill. This indicates that the company is following proper recognition and measurement of their intangible assets and goodwill and disclosing the facts to their users of the financial statements. That's all for our presentation. Thank you.